morning, ladies and gentlemen. It is both a privilege and honor to introduce a leader who has defined excellence in banking and finance over 5 decades, Mr. K.V. Kamath. From transforming ICICI into a global institution to leading the new development bank and now shaping the future of Jio Financial Services as the chairman. His career is a testament to visionary leadership, deep conviction, and an ability to anticipate the future of financial services. But beyond these milestones, what truly defines Mr. Kamath is his humility, clarity of thought, and his ability to inspire those around him. I had the opportunity to work along with him in the recent past, and the warmth, encouragement, and especially his personal gestures and parting comments on my last day are memories I will always cherish. They reminded me that true leadership is not only about achievement at scale, but also about the human touch. We are deeply privileged to have him here at the Access India conference. Ladies and gentlemen, please join me in welcoming Mr. K.V. Kamath, and I request you, sir, to come onto the stage for a fireside chat. Now we are going to have the fireside chat session with Mr. K.V. Kamath and our group CEO, Mr. Sunil Rohokale. May I invite you, Mr. Sunil, onto the stage to join the chat session and continue with the proceedings. Thank you, Sunil.
Good morning again. It's really my privilege to sit next to Mr. Kamath. And I'll tell you why. Mr. Kamath is a university by itself. Whatever early stage corporate life, a corporate executive I am, where I started my career under his leadership in ICICI Bank, I think I owe to him personally everything, sir. My ability to think scale, think big, challenge the status quo of things, and actually speaking, when I told him that I'm moving ahead after 15 years of working with ICICI Bank, he was the one who said, he has given me all the best because that was my entrepreneurial experience of ASK. So I came in here in ASK 17 years back as a co-founder. And I think all the learnings actually came from ICICI Bank. I may be using only partly where we reached today. And I had to use n number of another strategies and the long-term planning for the firm as large. It's not an accident that today you see the global banks, global investment banks, the Indian private banks, Indian life insurance, Indian general insurance, Indian investment management firms, Indian private equity firms, all the leading firms are led by those who has been part of that university, which, sir, you led the university. So it's an amazing experience for me and my privilege to have a conversation with sir today to get his 50 years of looking back and looking forward in terms of banking and financial services perspective. So, sir, you've been always known for a thought leader, and you created a paradigm shift. And I classically call you as you have been the creator of modern banking. You've seen the 50 years of the financial services market, sir. So what are those transitional structural changes in the last 50 years this audience should know, which probably actually set the context for the next 50 years?
Thank you, Sunil, and thank you for those warm comments. And good day to all of you who are here. I think I can break it up into two periods, and then the second part of it I can probably parse it. The first one was 1971 when I started my career in a project finance company. ICICI was a project finance company. And that period extends to 1995, so exactly, say, 25, 26 years, when India was a closed economy. So I won't spend more than 30 seconds on it. And the a project that was being set up in India, we would call it a laboratory scale plant. It was not a commercially viable plant, but under a licensing regime, all plants were of the same size. And you had to go through rigorous approvals and things like that. But all that was dismantled in the early 90s. So the new, I would say, the industrial progress started in 1996. And you could see that thereafter in the growth rates that happened. So in the period 1971, 1996, you probably averaged 3 to 4% growth, maybe 3.5% growth. And from 96 onwards, it took a couple of years to adjust, but by late 90s, you were on to a firm 7-8% growth. And that has continued for most of the next 25, 30 years, except for some brief periods in between, which I believe Neelkant talked about, the period 2009 to 2014. But otherwise, it has been I think within this, I think there have been interesting shifts, because Indian entrepreneurs, once they were freed up from the shackles of the past, and we're talking of around the turn of the century, 99, 2000, they suddenly dreamt big. So the larger companies that you see today, whether it is banks, whether it is manufacturing companies, automobile companies, IT companies, they were all able to scale up post 2000. And I think they still have their youth in them. They're not old companies, because the old had to be reinvented, and they had to build for the future as it were. So from 2000 onwards, you have seen these companies scale up. That is one. They also made attempts to go abroad or internationalize themselves. They did it pretty successfully till Lehman, the events around Lehman happened, which meant that they were constrained in their access to capital and so on. And most of them had to come back to India and build businesses here. A couple of quick points, and then I will leave you to the next question within this. Because this period also corresponds with the rise of technology. So Indian institutions, whether banks or non-banks or services companies, could leverage technology very effectively post mid-90s. Because that again is the break point, because till then you were not allowed to access technology freely. Post 1996, you were allowed to import stuff and so on. And it also corresponded with the time when the mainframe went out of fashion. And you got, I would say, what I call more value for money type of hardware and software that was usable that came into the fore. So it all turned right for India at that point of time. And after that, it has been a journey where Indian companies have adopted and adapted newer technologies, whether it was first the cloud, open source, and now coming to this new exciting thing, which I'm sure somebody would have talked to you or will talk to you, that is the digital startups. The digital startups, including fintechs. Last count, I think there would be around 150,000 of them. I understand the fintechs in that are about 10,000. And these typically are not factored into the growth paradigm. But if I were to factor into the growth paradigm and look at what this would contribute, again, you can then look at certain things that have happened, say in China. Maybe 20-25% of the economy will come from this ecosystem in the next 4 to 5 years. So this is the lay of the land as of now. I think we are just about to take off. We are not on this flight path.
Sure. Sir, the other part is that whenever globe looks at East, and within the East, any emerging market, it's all India. Conversations are always on the table. So any country would be great depending on how stable, how resilient is the financial system to handle any global challenges. So what is your perspective that how is India's resilience at this point of time to handle any global or the local disruptions which can happen, because the cycles have been shorter and the surprises are many?
Yeah, Sunil, I think this is a right question for the audience to understand how India has evolved. I would say again, this 55 years, my journey, I can break into 3 parts. One is the financial sector up to the year 2000, the financial sector just after Lehman, and the financial sector after COVID. And I will not take too much time, not as my initial introduction, 30 seconds on each. I'll use one indicator. I won't use debt to EBITDA, but if I were to use debt to equity, debt to total equity and long-term equity, typically India operated on debt to long-term equity 2:1 as a formula, right from the time I started my project finance career, 2 debt, 1 equity. And even in that 1 equity, the project financing institution like ours, we would put in some part of the equity and they could go to the market to borrow the other. So that was the structure under which these laboratory scale plants were set up. But all that ended with the opening up in the 90s and 2000. I think Indian industry corrected most of these leverage issues. The central bank, the Reserve Bank gave them a helping hand. And a whole lot of debt was written off, a whole lot of debt was converted to equity. And actually companies started improving. So this was the first change. And leverage, which used to be 3:1, 3 debt, 1 equity, out of which 2 was long-term and 1 was short-term debt and 1 was equity, came down to around 2:1 total debt to equity. This is circa 2000. Post 2009, 2010, Lehman, there was a further correction. And I would say debt equity came down to maybe 1.5:1. Now, why is this important? Because you are essentially in a situation where any small shock because of the leverage killed you. So that was overcome by the 2010s. But yet there was one shock which had to be overcome, which was what I call the initial infrastructure rush, 2009 onwards for a few years. And there was, I think, a whole lot of projects. There were a whole lot of projects which are not completed because whatever you needed to set up the infrastructure project was withdrawn. So, for example, if you needed to be allotted land for a road project, that was withdrawn. You needed spectrum for a telecom project. After you were halfway in the project, that was withdrawn. I won't go into why. You needed coal for a power project. Halfway through, that was withdrawn. Your environmental clearance was withdrawn. A lot of things. For 3-4 years, there was a bit of, I would say, a churn, as it were, and the banks ended up holding a whole lot of bad paper. So that cleanup happened 2014 onwards, and went on. And I think post-COVID, companies have been able to clean up. What happened during COVID is, I think companies realized that they had to be more efficient to survive. And just that efficiency push was able to throw up improved results. And in that, they also learned that let us not over-leverage ourselves. So by now, if you look at the top 500 companies, the top 1,000 companies in the country, hardly leverage. There is no leverage. And when they deleveraged, it meant that they repaid banks. Because at that point of time, funding mainly came from the banks, not from the capital market. We'll talk about that in a moment. So that leverage which came from the banks, they deleveraged and paid back the banks. So the banks' balance sheets became healthier. They did not have NPA. So just to put two numbers in contrast, circa 2000, the total bad debts in the system, and we used to call it restructured and bad and non-performing, it was around 25 to 30%. Today, on a net basis, the banking system probably is one of the cleanest, with the net non-performing asset system-wide for the banking system less than 0.5%. For the better banks, probably 0.3 to 0.4%. So there's an order difference in terms of how this cleanup had happened. So you have good balance sheets in the industrial sector, the borrower sector, and the banking balance sheets have been cleaned up. So you have banking balance sheets which are pristine. Capital adequacy 16-17 is not uncommon. I would say it's common. 16-17 is what you see. And things are, at least on the industrial front, going well. There are some hiccups, which if Sunil asked me to talk about, we can talk about in unsecured lending. But that's a small part of your overall, the bank's books. So by and large, a very clean borrowing sector and a very clean lending sector.
Absolutely. I think, as you rightly mentioned, sir, I think the balance sheets of the banks is very strong. And there are different financial participants was created for the purpose they need to serve, right from the microfinance to housing finance companies to small banks to big banks and so on and so forth. Digitization, technology, governance, all have been, and all thanks to the regulatory regime, India has been, and RBI being in the forefront. And not only RBI, but I think all regulators in India has been quite active in expanding the market, but at the same time protecting the end customer, correct? Ultimately, that's the core purpose. Sir, given this background and the scale what we are expecting from this 4 trillion to going into 8 trillion in the next 7-8 years' time, in the next 10 years, if I have to take not very long view, but at least a 10-year view, what kind of additional transformation changes will happen in financial services as per your lens?
Yeah, Sunil, I think we need to understand the lay, as it were, of the financial services sector. Clearly, up to 2000, it was primarily banks. There were hardly any other institutions of size. 2000, slowly the private sector, say insurers came in, the asset managers came in. That's post around 2000. So they have scaled up since then. And thereafter, I would say the pension authority was created, the insurance authority was created. So they came into the market force. And people started understanding what these products are and started taking advantage of these products in the market. So you had, I would say, savings channel to these entities. So today, the lay is completely different from 2000, where when you had only banks, all these entities are there, and you got a very strong capital market. And I think that's what has brought most of today's audience here today. So the rise of the capital market, I think, is something significant in the last 15, 20 years, and also the rise of the insurance industry. Now, within this, the last 5 to 7 years have been, I would say the growth has been spectacular. That's the word I would use. And this has brought about one shift, which I think is important to understand. Whereas earlier, banks funded both retail, very little retail, but mostly corporate credit, and very little retail credit. Now it is getting to a situation where banks, non-bank finance companies are primarily funding the retail side of the business, and the capital market is funding at least the large corporates, their corporate needs through a variety of instruments. Long-term instruments, medium-term instruments, and equity-type instruments. So all that is being funded. Infrastructure today is funded through, again, capital market type instruments, plus the creation of InvITs has helped fund this line of activity. And similarly, on the real estate front, today you see a real estate investment trust. Now, this is a far change from just 10 years back, when none of these InvIT structures were there. And it would be probably right to say that everything in India was funded by banks. So that has now moved away to probably what I call appropriate funding. Because banks, which typically have a 1-year tenor in terms of their deposits, you have fixed deposits, maybe 1 to 3 years, average less than 1, and you got a large amount of savings and current account with the, probably on call or on demand, as it were. The average maturity 1 year, trying to fund 7 and 8 year projects. That used to be in the historical past. That also was causing I would say, a disturbance in terms of a balanced structure. That is now the past. So banks are in businesses where they ought to be in businesses, a shorter term, and the capital market provides a longer term funding. And within that, as you said, specialist institutions have come in. To serve the bottom of the pyramid, you've got microcredit institutions. They keep having their own challenges, but I would think that will stabilize with overall growth. Then you have non-bank finance companies lending a whole lot of the needs of the lay customer, as it is, in his retail context, whether it's a home, car, et al. And then you have banks also supplementing this. And increasingly, the digital part of it, the fintech firms that I talked, are all run on a digital platform, as it were. They come in and provide, I would say, funding using technologies which I think the banks are slowly adopting too. But the fintechs are at the forefront in terms of using technology.
So, sir, as far as India is concerned, when it comes to India's growth, I think what comes to the mind is infrastructure, then it comes income, then comes interest rate. That's very traditional definition which we have always time seen, whether it is a physical or a digital infrastructure. But going forward, what India has actually done in the last 10 years, and maybe more so the 5 year, the adoption and the penetration of this technology and innovation through the Trinity, Jandhan, Aadhaar, mobile, UPI, ONDCs of the world. What do you think is that this whole technology stack of India is going to really make an impact on India's banking financial services? Your perspective is most welcome, because you actually, and I would not exaggerate in saying that I call him as a father of modern banking, because he has been instrumental in creating that time of in late 90s, where the ATM machines in India were not networked. So every ATM machine was an individual ATM machine, and you can withdraw a certain amount of money once in a day. If you try it second time, the ATM machine will eat away your ATM card. To that, where digital banking, where the customers never came to the banks and they were in the lobbies or they were at their home. So, and creating disruptive banking 7 to 7 a.m. In the world, nowhere people have been using convenience of place and time, as well as taking care of every part of the income profile while doing banking. So, sir, now the life has changed. Hardly people do go to banks. I don't say they don't go. But with the digital stack and the digital adoption having done by the banks and the customers, where do you see the banking financial services taking? Because your new avatar in Jio is actually using this most significantly. So we'll be very happy to hear your new thoughts of use of technology in the banking financial services, sir.
Yeah, Sunil, I know, if you look at just a few years back, you said 5 years back, India, the story of India, also we put this way, it's a story of constraints. So everywhere you go, there is a constraint. And you try to find a solution which will enable you to overcome that constraint. So in simple words, you jump higher. So the use of technology was to jump higher. And you mentioned that ATM. That ATM 2000 was also to jump higher. We didn't have the branches. And the regulator was not giving us the branches. We had some 500 branches, where the largest bank in the country had 10,000 branches. So how do you do? So we said we roll out 1,000 ATMs in 1 year, and we keep doing it. And they're all interconnected and they'll work. And that happened, and then you grew. So that has been the same constraint. And you cut to 2020, COVID hit you. Why did payment services, digital or digitized payment services, which we call UPI, why did they take off? They took off because you had a constraint. How would you pay at that point in time when everybody was locked in? And again, the banks had to make sure that the technology platforms worked. There were payment systems which were not using physical money, and so on. So I think that again brings to the fourth, one characteristic of the Indian market. One, I said, is theory of constraints. You jump higher. The second is adaptability. People learn to adapt very quickly because of a constraint or because of a ease of operation. And I think UPI initially was a constraint. Now it is ease of operation, which has... But in every area, this has been facilitated. And I think also driven by young India, because India, maybe a very old civilization, but if you look at the average age, it's a young country. So the young people are the early adapters, and then they push. So if I look at India, today's opportunity, India is driven by primarily a young India. There are the older people who will also be consumers. But you got a large burgeoning class of young Indians. And that provides you the long runway. Now, you overlay that runway with the fact that there is so much to be built. And as you go from here to Pune to Delhi, I was told you will go, you will see what needs to be built in the country. And it is getting built. Things are getting built at a very rapid pace. But the runway, then if you benchmark to other countries that you have been to, you yourself will assess that you have got at least a 15 to 20 year runway of building, the sheer time that will take you to build what you have to do without overbuilding. But a 15, 20 year runway with growth at 7% or so, I think allows you to double your GDP very easily. And we're talking of probably 2 turns. So you talked of 5 to 10, 10 to 20 then, give or take. So I think the next 15, 20 years we have a growth path because things have not been done and we need to do those things. And that runway of growth exists. And if young people weren't there in the country, then that growth runway would have again contracted. So you have the young people. So I would think you are in a good place, as it were, to do this. A. B, I would think, is the challenge of, in a lot of domains, regulation which is weak. And so we have had, I would think, between the government and the regulator, we probably have the best of what we could have. And by that I mean no shortcuts, very careful in terms of allowing you what to do, very strict supervision, and they will do things after they have evaluated all, I would say, from all angles, and then taken a decision that this is the right thing to do. You mentioned interest rates. I think movement in interest rates is very, very measured in this country. I don't know, today or tomorrow there is a monetary policy meeting, but I don't know whether anything will come of it, because they just did a little bit of easing in the previous 2 quarters. So again, what I'm saying is very tight regulators. They want to be at the forefront of regulation. They want to be well benchmarked with the global thing. So from that point of view, which in certain domains is a problem, it doesn't exist. So to sum this part up, you have a long growth runway. Balance sheets are, twin balance sheets are cleaned up, corporate and the lenders' balance sheets are. The institutions which allow for growth are in place, that is the regulatory institutions. And they are very cautious and very measured in what they do.
Sir, sir, with all this adoption of technology and having a regulation which is quite an enabler so that it increases the productivity and efficiency of the whole financial system, what do you think the next technological disruption is going to come into banking financial services? And how is the role of this AI, so much of been talked, is going to be, either it is going to be beneficial to the banking, whether it will impact the banking in a particular way which is constructive, which may create an impact on customer experience, personalization. So what do you think is disruptive in technology and innovation is going to impact on the banking? And second part is that how is the role of AI, you think, is going to change even banking further, which is a part of disruption?
Yeah, I think this is a continuing process, and we will not just our runway of 15, 20 years, we will have to live with these changes as we happen. So you ask specific questions. Nothing is going to change overnight, because let's take fintechs. Fintechs came in, they brought modern technology. But traditional banking still continued and still continues even today. So change will be slow. But there are certain areas where you will probably have a rapid improvement. A few of them, if I were to now conventionally understood that all areas where you're talking of customer service, I would think that is low-hanging fruit. And you could provide better customer service and at a lower cost. So that, I think, is a given. Then, in terms of, let's say, a very simple basic thing in banking, approval or non-approval, I think tools could be used to, look at several indicators to come to a decision of going ahead or not going ahead. That also will lead to efficiency. And in India, those secondary and tertiary data points do exist. So you can pull those and you can have a platform which helps you in decision making. I use the word helps you and not takes the decision, but helps you in decision making. So these 2 areas and in general running of the organization, I think you will see efficiencies. But will this mean that you will have a dramatic drop in bank employment? There will be, but it will be gradual. And in any case, in the Indian context, you probably need to have a bit of a dramatic drop in overall what I call cost to income ratio. Because if you looked at the cost to income ratios of banks in India, you have got banks in the, say, 40s, low 40s, going right up to the 70s. And I think you have no business to be in business if you are at a cost to income ratio of 70. So you need to, and I would think that proper use of technology probably will allow you to bring this down, the cost to income ratio down to between 25 and 30%. So I would think that is what we should give. And that is for the good of everybody. So clearly it is going to be of advantage. But having said that, the Indian financial system, and I'll be very honest, has a rather steep road to climb to get to the point where they will use newer technologies, because they have not yet gone past the technology that they were using in the 1990s. That is the first wave of technology. That's where they used technology for the first time, I would say. The Western banks were still using mainframes. We did not. We went into distributed systems. Then everybody went to distributed systems. A few of them are going to the cloud now. They have not gone to the cloud. Hardly any. Again, maybe 3, 4, barring 3, 4 have moved on to more recent systems, open source and other and SaaS-based packages. So adoption has been slow, and this is understandable because there's always fear. What if something goes wrong? So finally, they will have to take the call, because otherwise the challenger is going to be at the gate. I think the challenge is already at the gate.
Yeah, absolutely. So, sir, we have today's conference. We have investors coming from 12 different nations, and global investors always have been watching emerging market and India in specific, and it has been exciting to have the conversation when we meet them into their countries or when they visit us here. Today's conference, I probably would like to hear your perspective. What are those misconceptions the global investors generally carry? You must have heard about when you talk to them, and what is the kind of care or what kind of risk mitigation or what kind of awareness they should have while they invest into Indian market? I think it's very important to have the clarification of misconception, and at the same time, it should also be clear that what should you be aware of the risk of Indian markets as well when they look at India allocation.
Yeah, I wouldn't say misconception, but a lot of investors do not know India. And by investors, I don't mean individual investors. The country where they come from, wanting to take a look at India, there is not that much of a deep understanding of the place. So what I would actually task a firm like yours to actually get this, I would say the process of getting to know India, showcase to them. And you're taking the team, the group, to say 2 other cities. I think is a good step in this area. So you get to understand, because typically there used to be this old saying that you talk to somebody from a third country, they will talk about transformation that has happened, which is of a different order. And I think simply put, you could showcase what has happened on the infrastructure front. Yes, there is still a 15-20-year runway, but we probably have the largest number of data users in the country. We have the largest, after China or equal to China, cell phone users in the country. So it works, and it works at a price point where which is nowhere else to be found. So how? So I think if there is curiosity, you should satisfy that curiosity as to how is it possible to make available data and telephony available at make it available at price points which are unreal. So this one. I think slowly the road network is coming together. You should showcase that. The port, seaport coming together. Railways are on a massive expansion. Airports are again coming together again on a massive expansion. And I think key thing to showcase is green energy. The way green energy is going on. And there's a very interesting, I would say, side story here. We used to always say that India is always late to the party. Anything that you see that has happened in the world, we would adopt after quite some time. And we have now seeing the benefits of that. So, for example, we did not get into green energy. Well, we got in, but in a very fledgling way, when it was costing us 12 rupees a unit. But we are now scaling it up when it is costing 2 rupees or 2.5 rupees a unit. So probably did well not to invest heavy sums at that point in time. And so in a series of things, you see that we were late to the party, and we are now, in a way, harvesting the plus side of that. And it's happening even today. It was so in technology, it was so in telephony, it was so in power generation and so on. But slowly, I think we are getting to a stage where we are developing our own solutions, as it were. And these are cost. And that's why I'm saying that we may not have to go through a binge of fossil fuel-based power plants, because the rate at which we are able to add new green capacity probably will balance out growth needs.
Is there anything specifically they should be aware about the risk associated investing into India for long term?
Again, I would look at history. Sometimes is the best indicator of. Though in your business you say that past performance is no indicator of the future, but you look at a point, a very long period of time. I'm talking in a behavioral context. Has there been any behavior which is undesirable, which is unpredictable? I don't think you will find that at all. You go back to the period when I was saying, I said that the first 25 years of my career, 71 to 96, when you were growing at 3.5%, but you did not renege on any of your commitments. And you are not reneged on any of your commitments thereafter, in whichever area that you operate in. You will, the risks that you will, I would say, run are, I would describe them as short-term risks. They will even out. Now, you may say that, can you not avoid them entirely? I think in life at times it's difficult, because again, we are a democracy, and in a democratic process, if there is a change in government, they may have a different priority. So you will see that priority playing out, and but ultimately you get back to your growth. So I don't think, over a long period of time, there have been no hiccups in terms of in the way we have conducted business as a nation. It is always, in a way, rather boring and predictable. Which is good.
So the last sentence what you just mentioned, the boring and predictable, actually took me back to my bank days, because Mr. Kamath used to always say that financial services is very boring. When you are in a boring business, you can create alpha through execution. Your premium is in execution, because you are in a boring business. And that is what exactly the bank has done, and this is exactly what we are also trying to do at ASK. We are in a boring business, but seamless execution, superior execution can create premium and the alpha for the delivery. So, sir, I think that's execution is one portion which probably have mitigated through so many policy push, digitization, innovation, government also changing the policy terms, and hence the execution risk of the country also has been mitigated to that extent, isn't it?
Yeah, I think you're absolutely right, in the sense that the urgency to execute and the speed of execution and the quality of execution makes a difference in a boring business. So, I won't spend more than 5 seconds. Our 90-day rule was the differentiator to make a boring business exciting and disrupt competition. The 90-day rule was very simple. Anything that you have to do in 90 days. So new software to be implemented, a new package to be implemented, 90 days. Everything in 90 days. And then people actually aligned and did it. Now, in India's context, if you see, there were no timelines for implementation, because a project could take 3 years, 5 years, 7 years. It was all the same. But so you got it into your mind that execution at speed is not possible in India. So that could be taken as a risk. It does happen that you don't execute at speed, so that risk still is there, it's not gone away. However, today you can showcase a number of projects which have been implemented, large infrastructure projects in record time. And I'll take only 2 of them. Sure. And one of them, I'm sure they already traversed that road when they came from the airport down to this hotel, the new coastal road. This new coastal road took exactly 3.5 years to build. In the typical Indian mindset, my Indian mindset, I would have thought this is a 15-year project. Well, they've started it. They started it during COVID, 2020, June they started it. And 3 years later, it was functional. Then there is another bridge which connects Mumbai across this harbor on your right, sitting there, to mainland, it's about 25 kilometers long. It's over the sea. It's a trans-harbor link. That again in about 3.5 years. I would have never in my life thought that we will complete it. So to me, if I were in your shoes, if ASK can demonstrate to you there are 25 such projects that have been done, to me it gives me confidence that India, there are more chances of things going right than of something not being done. The past, it was always, what happens, things probably will go wrong because of A, B, C. I think now there are more things going right than going wrong.
No, absolutely. I think every industry has got the regulators to ensure the stakeholders are being protected. I think some of these changes, like real estate, the Real Estate Regulatory Act passed, and that gives enough confidence to the home buyer and the others. So the last one, I know it is, but just wanted to have your view with this whole supply chain disruption and the global geographical conflicts. How is that, you think, is going to impact the Indian financial services sector? Is there you see any impact? Obviously, as a country, we would have some or the other, but you see anything in financial services?
No, not in financial services as I can see. That as now, I don't see any challenges there. But if you look at a larger context in terms of the tariffs that have been imposed and so on, we'll have to see how it plays out. Because we see almost periodically things changing. And our understanding of what really is what is meant is not very clear. You saw, I don't know whether you're meeting in technology companies, this whole news about $100,000 fee for an H-1B visa. And every day since then, you have been learning a little more about it. But I would think by the next couple of days, at least the Indian companies would have discounted this, as this is not really material for them. It may be material for some companies in the US, but not material here. So I don't think we should overreact to anything. But having said that, the key thing that I would look for is, if you have a large enough domestic market and you can meet that market by yourself, I think most of your challenges are overcome. But if you are going to rely on 70% of your market is third party, and that could come under shock anytime, then you have a problem. But in India's case, all along, I start long back. If I look at, you relied on the external market for maybe 10-15% of whatever you consume. So it was at the margin, and I think it continues to be at the margin.
Yeah. So the economies actually have moved, because we were discussing about the domestic savings getting channelized into mutual funds. A small SIPs actually have created a magic. A 3 billion every month coming into the capital market is a good counterbalance to the other flows of capital. So the last one, just to ensure that what kind of governance standard the Indian managers should, according to you, should follow to get in the confidence of the global investors? What is that you would like to leave a thought behind?
Yeah, I'll come to that, but that inflows from the domestic investors, at some point in time you should take our friends who are here as to what is actually happening. I think what he's talking about is what's called the systematic investment plan. Please, if they have not been taken through, please take them through. This is basically you're committing to move something into your mutual fund every month for a long period of time, 10 to 20 years. And now it has become a sizable flow monthly. So what it is doing is not only, it is also providing stability to the market. So you asked me that question, is the market stability? given sum coming every year, every month, and the investor has committed to put money over a long term, I think you should take our friends through how it works and what stability it provides to the marketplace. To me, that's an interesting side. What is the question?
So I said for the global investors, to gain the investing confidence, what kind of governance standard Indian managers like should have?
Yeah, good, very excellent question, because some of it I've answered. If you are going to take 7 years to implement a project and you really don't know whether you will have that in 7 years or it will take 9 years, I think that is not going to add confidence. But now, demonstrated ability to do things in a shorter while. And then let's go to one area that you mentioned. I think you mentioned real estate. Real estate also was free for all. You were building a commercial complex, residential complex. The builder took money from you on he took money regularly, every 3 months, every 6 months. And he would take the money and then invest it in another, buying another plot. And your project is stuck. Now, all this is now regulated, last 3 years, wherein he basically signs a contract with the government saying that I'm starting this project now, and by this date the project will be up. Otherwise, these are the penalties I have to bear. So now it's not between you, the builder, and the buyer, but the government comes in, which is the real estate regulatory authority, A. And B, no longer can he take money from the customer every 3 months or 6 months. He says, you pay me now 10% down, and the balance after 3 years or whenever I am ready to. So the builder now has to fund himself. So what I would say is discipline has been brought in. And if discipline you extend, that is governance. And these were probably some of the most difficult areas where there was, I would say, lack of infrastructure build out and real estate. So those have been tackled. And as far as the other manufacturing sector, the financial sector, and the utility sector, appropriate regulatory structures have been put in place. The regulators have teeth. And as a result, your ability to now say that I am investing in this and I expect my money to come back is far better than what it was 10 years back. Take, for example, 10 years back, you built a power project. The buyer, a so-called distribution company, which would typically be government, the local province owned, never bothered to pay you. And it had a take or pay contract. So it took, but never paid you. Now, all that has been now brought to order. Again, there is like you have a stock exchange where you will buy and sell, there is a power exchange. So deals are done through the exchange. So there has been a continuous tightening in terms of the structures in place to put in place or to enforce proper governance. And I would compliment the financial regulators in particular for making sure that that structure in the financial services business is clearly understood and in a workable condition.